Hello guys, welcome back to my channel. My name is Noval Adianto from IPMI International Business School MBA Program Batch 2020. So today I would like to share to you guys my learning journey for corporate finance class delivered by Prof. Roy Sambo. So to make it easier, I create this mind mapping and hope that it make you easier to understand about corporate finance. And please stay positive while being negative during this pandemic situation. Okay, without further ado, let's start. Corporate finance. For the first week, we learn about the introduction to financial management. In financial management, we learn about the objectives of it. The objectives of it consist of basic objective, social objective, operational objective, and research objective. Then move on to value creation principles. For value creation principles, we have base owner, conservation of its value, core value, and expectation of treadmill. So what is best owner? Best owner is a business value depends upon its owner capabilities. For conservation of value, you can't create value by rearranging claims on cash flow. And then core value principles is a value is driven by returns on capital and growth and cash flows. And then for the expectation treadmill is the more investor expect of your share price, the better you must perform to keep up. That's the value creation principles. And then we move on to what to manage in the financial management. First, we need to manage capital structure by a lower debt to equity ratio. And then risk management. For risk management is a lower risk appetite. And then cash flow management, the third, is the focus on 5 principles of cash management that later on I will share to you guys about it. And then the cash management, asset structure, working capital management, and revenue management. That's what I learned for the first week for Introduction to Financial Management. Then move on to the second week, we learn about the time value of money. For time value of money, we learn about the present value and future value. Then capital budgeting, that's still in line with the time value of money. What is capital budgeting? Capital budgeting is estimate expected future cash flows. Also evaluate the project based on capital budgeting evaluation criteria and decide whether or which project is good or bad. And 2 or more projects can be mutually exclusive, may choose only one, and independent, may choose all good projects. And then we have methods for capital budgeting. The first one is NPV, or net present value. And then we have IRR, or internal rate of return. And then we have payback period. And we have profitability index. And all of those methods consider all cash flows, time value of money, and require rate of return. Okay, and then for time value of money, payback period doesn't adjust for timing differences. Mind the other methods, it take into account the time value of money. And then relevant cash flow, and NPV, IRR, and profitability index use all cash flow, while payback method ignore cash flow that occur after the payback period. For the NPV, we assume cash flow are reinvested at required rate of return. Meanwhile, IRR assumes that cash flow are reinvested at IRR. And for the conclusion for these methods, NPV is the better method for project evaluations. And then the capital budgeting concept is the planning process for investment in long-term asset and decision-making criteria for a long-term investment proposal. And then we can move on to accept this or reject this. Then we move on to the corporate restructuring. For this corporate restructuring, there is several things on it. The first one is the capital structure, and then working capital management, asset structure, revenue management, cost management, cash flow management, growth management, and risk management. That's the things that we need to go deep dive to understand about the corporate restructuring. Then we move on to the portfolio theory. For the portfolio theory, there is several things that we need to understand. The first one is the potential future return, actual or historical return, and required return on the portfolio theory. And then the second one is ex ante or probability weight versus ex post or simple historical average measurement. Then we also have to understand about return versus risk. And then we need also to understand about total risk. And then correlation and diversification, efficient frontier portfolio, and portfolio theory and CAPM. For this one, as you can see, CAPM based on the correlation, beta, and variance. Then after that, we could see the capital asset pricing model using CAPM. And return of risk, we have to understand about systematic and unsystematic risk. Then we move on to the analysis of securities. For the analysis of securities, there is two fundamental things that we need to understand. The first one is technical analysis. The second one is fundamental analysis. For fundamental analysis, we can see it from the financial statement, which consists from profit and loss statement, balance sheet, and cash flow statement. And then we should also understand about financial ratios from the market ratios, liquidity, efficiency, leverage, and profitability ratio. And the big picture of this analysis of securities, there is passive investing and active investing. For passive investing, you just follow the market. But when you are talking about the active investing, this is what we need to learn. This is what we need to understand. Fundamental analysis, technical analysis, and market or investor sentiment. Okay, we move on to the international finance. We start for spot versus future market, and we talk about the arbitrage. What is arbitrage? Arbitrage is buying and selling of securities, currency, or commodities in different market or in derivative form in order to take advantage of differing price for the same asset. In other words, it means the forex market. And there is three things in forex market about arbitrage. The first is locational. The second is triangular. And then the third one is interest rate. For locational arbitrage, it ensures that quoted exchange rates are similar across banks in different locations. For triangular arbitrage ensures that cross-exchange rates are set properly. And then for the interest arbitrage, ensures that forward exchange rates are set properly. By doing the arbitrage, we could create the opportunities by making money machine. For instance, you borrow 10 millions with interest rate 30% for the next year, and then you convert it 10 million rupiah to the Singapore dollar with spot at 10,000 rupiah per $1 Singapore. And then you deposit it in with interest rate 10% per year and sell dollar forward at 15,000 per Singapore dollar. That's for the arbitrage. And then we talk about the options. The options, there is a put options and call options. What is options? Option is a contract that gives its holder a right to buy, that we call call, or sell, that we call put, a certain amount of certain underlying asset with certain predetermined price, strike, or exercise price at a certain time in the future. And then we move on to the exchange rates. After that, we also learn about the dividend policy. For this dividend policy, there is three main aspects in it. The first one is constant dividend payout ratio. If a director or management declare a constant payout ratio, for example, 30%, then for every rupiah of earnings available to stakeholders, it will be paid off as dividends. And then the ratio remains constant over time. And then the second one is stable dividend policy. The firms try to pay a fixed dividend each quarter. Firms and stakeholders prefer stable dividends, and decreasing the dividend sends a negative signal. The third one is the small or regular dividend plus year-end extras. The firm pays a stable quarterly dividend and includes an extra year-end dividend in prosperous year. By identifying the year-end dividend as extra, directors or management hope to avoid signaling there is a permanent dividend. And then we move on about the fraud risk management. For this one, we learn about why and how to prevent fraud, and then statistic of who conducting the fraud and whistleblowing. For this fraud risk management, there is a fraud triangle, we could say. This is a perceived pressure, perceived opportunity, and then rationalization. For perceived pressure, there is financial pressure and work pressure. Let's start with the financial pressure. There is a greed, addiction, poor credit rating, or press management. For work pressure, is dissatisfaction with pay and overlook for promotion. And then for perceived opportunity, there is a weak internal controls, ineffective monitoring of controls, and asset susceptible to fraud. The last one for rationalization, there is several saying like I'll pay it back, and then I deserve a pay rise, and it's for a good purpose. That's the fraud triangle. And for whistleblowing, it's act of reporting a misconduct to managers, executives, or other authorities with the power to take corrective action. And the last one, we are also learning about the sovereign wealth fund. There is what is SWF, and then possible problem from the sovereign wealth fund. And then we also learn about the types of SWF. And for these types of SWF, we learn about the stabilization fund, and then future fund reserve, and then reserve investment fund, and pension reserve fund. That's what I learned about this corporate finance class from Prof. Rosamble. Hope that this mind mapping could help you all to understand more about this corporate finance. And see you guys. Thank you. Bye-bye.